Okay, in this chapter we're going to do stock valuation. So in chapter 7 we did bond valuation. In chapter 8 we learned how to calculate the discount rate to do stock valuation. And now in this chapter we're going to actually learn how to value shares of stock. This facts about common stock, this is stuff you can read, and so I'm not going to waste any time going over that. Alright, so we talked in chapter 1 about the intrinsic value of the stock versus the stock price. And in general, most of the time, those two should be pretty close. People are always trying to figure out what is the intrinsic value, and in particular, does it differ from the stock price because that's a buying or a selling opportunity. So we try and estimate the true value or the intrinsic value of the stock, and so what that would say is if we come up with an estimate of the intrinsic value that's different than the market price, that means that we either have information the market doesn't have, or we're smarter than the market and we can figure out what things mean. Now remember that stock prices are about the future. Stock prices are reflecting the present value of future cash flows, and so there's a lot of uncertainty there, and so some news strikes and the market tries to figure out what does that mean for this stock, and the stock price adjusts. But so all of trading is about comparing the intrinsic value to the stock price to try and find an undervalued or an overvalued stock. And so this is a graphic of what I was just talking about. So all kinds of things can affect stock prices. What management does, for sure, the economic environment, taxes, the political climate, the situation in Europe, everything affects the stock price because it has the potential to affect future cash flows. And so the problem is that there's what will actually happen, how these actions actually will affect the cash flows and the risk, and then there's the perceived cash flows and the risk. And again, it's because we're predicting the future, and so we don't know for sure what will happen. So we end up with the true cash flows and the true risk being reflected in the intrinsic value, and that's the one we'll be calculating, and then the perceived cash flows and the perceived risk determining the market price. And so when we talk about equilibrium, what we're talking about is saying the intrinsic value is equal to the stock price. And so in general, most of the time we think the market is in equilibrium. And if it's not, there's a buying or a selling opportunity because the stock is mispriced. So different methods to calculate the intrinsic value of the stock. And I'm going to focus on the first two, the dividend discount model and the corporate valuation model. All right, so if we think about it, I think I mentioned in a prior class that the value of any asset is equal to the present value of the expected future cash flows that the asset's going to get. So in this case, a share of stock, the future cash flows are dividends. And so the stock price is the present value of a bunch of future dividends. Now, note the little hat here. Hat on top of something means expected, and P0 is price of the stock today. This is times 0. So the expected price of the stock today, what we think it should be, the intrinsic value, is equal to the present value of the future dividends. Okay? Now the problem is the dividend stream is infinite. And so this model is a little tough to work with when you've got an infinite stream of cash flows. And so there's shorthand that if you have an infinite series of cash flows, it converges to this model down here. So the expected price of the stock at time 0 is equal to D1. D1 is D0, the dividend today, and the assumption that we make is that D0 has already been paid. So if you buy the stock today, you're not going to get D0. The first dividend you'll get is the one next year. And if the stock is growing at a constant rate, D1 is going to be equal to D0 times 1 plus G. Okay? So the last dividend paid times 1 plus the growth rate is equal to D1. The present value of an infinite growing stream is D1 over RS minus G. RS is the CAPM required rate of return. G is the constant growth rate that the dividends are going to grow at. Okay, so if we have a very simple problem where we either know the next dividend or the last dividend paid, and the stock is growing at a constant rate, we can use this really simple formula to calculate what the stock price should be. Okay, so to use this model, several things have to happen. A, the company has to pay dividends. B, they have to be growing at a constant rate. And then we can calculate the stock price. Okay, now the dividends, the red line are the dividends, the actual dividends, and they're obviously getting bigger, right, because they're growing by G% a year. So every dividend is bigger than the last one by G%. The present value, on the other hand, gets less because we're discounting at 1 plus R, and R is greater than G. The required rate of return is greater than G. So we're discounting them faster than they're growing, and so their present value gets less and less and less. And so a dividend far out in the future actually is worth almost nothing. Okay, so what happens if G is greater than RS? And the answer is it can't be, it's impossible. And the reason is not just a mathematical reason, it's because G is the capital gain. It's the rate at which the stock and the dividend are growing, and so that's the capital gain. And so just like in those bond problems we did, remember when we had the yield to maturity is equal to the current yield plus the capital gain? The same thing is true with stock. The total return, RS, is equal to the dividend yield plus the capital gain. So it's not possible for G to be greater than RS. That doesn't make any sense. RS is G plus something. So at a minimum, RS is equal to G if the company doesn't pay a dividend. Okay? So mathematically it doesn't work. It's going to give you a negative stock price, but intellectually it doesn't work either because R is equal to G plus the dividend yield. So step one is we use the CAPM to calculate the required rate of return on a stock. So assume this stuff, assume that the risk-free rate is 7, the return on the market is 12, and beta of this stock is 1.2. So the first thing we have to do is figure out what is RS, the required rate of return on the stock. Okay, now again, remember the stuff with the hats and the no hats. RS with a hat on it is the expected rate of return, what I think I'm going to earn. RS like this is the required rate of return. That's the return that I need to earn based on a beta of 1.2. Okay, so my risk-free rate is 7 plus RM minus RF times the market risk premium times the beta gives me a required rate of return of 13%. So find the expected dividend stream for the next 3 years and their present values. And so D0 is 2 and it's growing at a constant rate of 6%. So 2 times 1 plus 6 is 212. 212 times 1.06 is 2.247. Times 1.06 is 2.382, okay? And we're discounting them at 13%, so you can just divide this by 1.13, 1.13 squared, 1.13 cubed, or you can say future value, N is 1, I is 13, what's the present value, okay? So this is what that picture showed a few minutes ago, that the dividends, the nominal dividends are growing, but their present value is shrinking because we're discounting them at a higher and higher rate. Okay, so we can use what's called the dividend discount model or the constant growth model to figure out the expected stock price given this information. So D1 is 212, and so the stock price is D1 over RS from the CAPM minus G, $30.29. Okay, so that's the expected stock price given the information in this problem. Okay, really simple model, D1 over RS minus G. So what's the stock's expected value from 1 year from now? So this model is completely general. We can find the stock price in any year by just taking the dividend in the next year. So P1, the stock price at time 1, is D2 over R minus G, and we figured out back here that D2 is 2.247. Okay, so 2.247 over 13 minus 6 is 3210. I could figure out P25. P25 will be D26, and so I just have to keep inflating my dividend by 6% each year to figure out what it is, okay? So the stock price 1 year from now is going to be D2 over RS minus G, and that's 3210, okay? Or we could also find the stock price, if it's a constant growth, we can just multiply the stock price times 1.06, and that's going to give us the same answer, okay? So then we can, just like we did with bonds, we can find the dividend yield, the capital gains yield, and the total return. So the dividend yield is D1 over P0. So here again, the assumption is I buy the stock today for $30.29 and I'm going to get a dividend next year of $2.12. So it's just like the current yield in the bonds. It's D1 over P0, so my dividend yield is 7. My capital gains yield is P1 minus P0 over P0. So we just figured out 32.10 is P1, 30.29 is P0, and so my capital gains yield is 6%. So my total expected return is 7 plus 6 is 13. And that happens to be equal to the required rate of return, but these are two different concepts. The required rate of return comes out of the CAPM and it's based on risk. This is what I actually expect to earn, and it's based on my forecasts of the cash flows. Now, the fact that the two are both 13 means that the stock is in equilibrium. It's correctly priced. What I expect to earn is equal to what I require, so this stock is correctly priced at $30.29. Okay, go back to that one for just a second. So it's a really, really important concept. They're both 13, but they're two different concepts, required return versus expected return. And if they weren't equal, it means the stock is mispriced and there's a buying or a selling opportunity there, okay? So we expect these two numbers to be equal, but they're coming from different places, the required versus the expected. What would be the expected price today if growth was 0? Well, if dividends are growing at 0, then they're going to be 2, and so our formula is still the same, D1 over RS minus G. D1 is going to be equal to 2 because it's not growing, and RS minus G is going to be 13 minus 0. And so when growth is 0, it just devolves into payment over R. But it's the same exact formula, it's just that G is 0. G is still here, it's just 0. So if the growth rate is going to be 0, the stock price would be $15.38. And that's a result that makes sense, right? If your dividends are growing at 6% a year, the stock is going to be more valuable than if they're not. So if your dividends are not growing, the stock price would only be worth $15.38. Now, what happens if it grows at 30% for 3 years and then it slows down to 6%? All right, now we can't use the constant growth model anymore because we've got two different growth rates. And so what we do in this case is really simple, and students always struggle with this, and I can't figure out why, because it's not difficult. So we draw a timeline. You have to draw a timeline in a problem like this. So this is how we value stocks with non-constant growth. We forecast the dividends out for as long as the non-constant growth is occurring. We forecast them out one by one until we can see constant growth in the future. So in this problem it said it's going to grow at 30% for 3 years, and then after that it's going to grow at 6. So at the end of 3 years, as I look into the future, I see a constant growth rate of 6. So at that point in time, I can use the constant growth formula to calculate the stock price at time 3. Okay, so let's walk through this. So D0 is $2, and it's going to grow at 30% for 3 years. So 2 times 1.3 gives me 260, and then that's going to grow at 30%, so times 1.3 is 338, times 1.3 is 439. Okay, at the end of 3 years now, as I look into year 4, I can see 6% constant growth. So at this point in time, I calculate D4, so this is 4.394 times 1.06 is 4658. So this is D4 over RS minus G, and that's 6654. So this is the stock price at time 3, okay? And so I'm going to show you how to do this on the calculator, because I wouldn't actually discount the cash flows one by one like this. So pulling up my handy dandy HP calculator here and putting it where we can see the cash flows. So I'm going to clear all. I just activate it, so I think it's all clear, but just to be sure. And I'm going to set my calculator on 1p a year because it can mess you up even here. So 1 p per year. And then I'm going to clear all again just to see, and I'm going to set it on 4 decimal places. I have to reset every time I use this. So display is 4. Or 4 is display. Or how about display 4? There we go. All right, so remember we use the cash flow keys. So in this case, again, the assumption is that D0 has been paid. So I'm going to leave D0 out of this. So cash flow 0 is my first cash flow. Okay? What is that here? 0. We'll see if it works. Okay, 2.6 is cash flow 1. This isn't looking good. Hang on, let me see. Why is it doing? Alright, so 0. Oh, because I don't use this calculator. Okay, I don't need the orange key. It's CFJ. So 0 is cash flow 0. Okay, now we're okay. Now 2.6 is cash flow 1, and the 1 pops up there. And move this guy over. 3.38. 3.38 is cash flow 2. And then in year 3, I've actually got 4.394 plus the stock price of 66.54, because I've got 2 cash flows in year 3, right? I've got D3 and then I've got P3, which is the present value of all the dividends after time 3. So my total time 3 cash flow is 70.934, and so now I can just hit cash flow 3. And so if I want to find out what's the present value, my discount rate is 13%, so I'm going to say 13 is my discount rate, and I want to calculate the NPV. So here I use my orange key, and I get 54.1087, slightly different than this, just due to rounding. Okay, so that's how you would do it on your calculator. I wouldn't discount the cash flows one by one. You can do whatever you want. But so the key thing here is that this is P3, the stock price in time 3, and 66.54 is the present value of all the dividends that come after year 3. Okay, so it's a time 3 cash flow, and I add it to D3 to get the stock price of 54.11 basically. Okay, might need to watch that twice, I don't know. All right, so find the expected dividend and capital gains yield during the first and the fourth year. So D1 was 260, and we figured out the stock price was 54.10. So the dividend yield in the first year is 260 divided by 54.11, 4.81%. Now, just like on the bond problem, we can do this simply and say, okay, I know my total return is going to be 13. The dividend yield is 4.81, so therefore the capital gain is 8.19%. Okay, that's in the first year. Now, what happens by the end? So find it during the first and the fourth years. So after time 3, at any year after time 3, the growth is going to be 6, and so the capital gains yield will be 6. So 13 minus 6 means the dividend yield will be 7. Okay, so we can figure out the price and solve for the dividend and capital gain every year in between, but once we hit constant growth, the capital gains yield will be 6 and the dividend yield will always be 7. Okay, so here's another non-constant growth problem. So what if G is 0? It doesn't matter, okay, it doesn't matter what G is in the beginning years. So if G is 0, then I've got 2, 2, and 2, and then it becomes 6%. So here at time 3, I've got D4 is 2 times 1 plus 6 is 212 over RS minus G, and so my stock price in time 3 is now 30.29, and I do it just like I did the other one. Cash flow 1, cash flow 2, and cash flow 3 is 32.29, and I solve for the price, and it's 25.72. Okay, so this non-constant growth model can be used with any set of growth rates, and you just need to forecast the dividends out until you see constant growth in the future. And then like the problem before, so the dividend yield is 2 over the price, 7.78. So the capital gains yield then is 13 minus the dividend yield. And then again, once growth settles down, the capital gains yield will always be 6 and the dividend yield will always be 7 because they have to equal 13. So, if the stock is expected to have negative growth, would anybody buy it? And the answer is sure, because it's still has value and it has a price. And so the only change is the formula is still the same, D1 over RS minus G. And so the only difference is it's going to be 1 minus G because growth is negative. So it'll be 2 times 1 minus G is 0.94. The dividend is shrinking. And RS minus a negative. And so the stock price is $9.89. And so this is as you would expect. If growth is negative, the stock is going to be worth way less than if growth is positive. But it still has a positive stock price because it's still paying dividends. Okay, and then here's the capital gain and the dividend yield again. And so the capital gain is -6, the total return is still 13, and so the dividend yield, because the stock price is so low, is actually 19%, and that's why somebody would buy this stock. Now, what happens if the company doesn't pay a dividend? And in fact, most companies don't pay dividends. We can use the exact same methodology that we just used for the non-constant growth. The difference is instead of using dividends, we're going to use free cash flows. Other than that, it's exactly the same as what we just did. So the corporate valuation model, also called the present value of the free cash flows, tells us that the value of the entire company is equal to the present value of the firm's free cash flows. So to get from there to stock price, we just have to subtract the debt and divide by the number of shares, and we can come up with the stock price. So remember back to chapter 2 when we talked about free cash flow. So free cash flow is EBIT times 1 minus T, add back the depreciation and amortization if there's any, and then remember it's minus the change in the assets. So this is the change in fixed assets, and this is the change in net operating working capital. And remember, net operating working capital is the operating current assets minus the non-interest bearing current liabilities, and that was accounts payable and accruals. Okay? Remember that? So we still are using everything that we've learned so far. So to apply the corporate valuation model, we have to find the market value of the company. So we're going to forecast out the future cash flows and find their present value, and that's going to give us the market value of the whole company. From that, we're going to subtract any debt or preferred stock, and that's going to leave us with the value of the equity, and we can just divide that by the number of shares to get the stock price. Okay? So this is a perfectly general model that can be applied to any company. The first dividend discount model obviously can only be applied to companies that pay a discount. This model can be used to value any company. And it's actually more thorough because you're looking at free cash flows, and so it's more complex and more comprehensive than the dividend discount model. The actual process is exactly the same. We're going to forecast the free cash flows out to some point where we say, okay, these are going to settle down and grow at 6% a year. And at that point, we calculate the horizon value, which is what we were just doing with those stock prices. We call it terminal value when we talk about stocks. But we calculate the horizon value exactly the same way. And then we find the present value of all the cash flows. So using the corporate valuation model to find the firm's intrinsic value. Okay, so here we've got the weighted average cost of capital is the discount rate in this case. All right, this is important. So the long run growth rate is 6%. We use the WACC as the discount rate because these are the free cash flows to everybody, not just the stockholders. Okay, so that's a different from the dividend discount model. In the dividend discount model, the discount rate is the cost of equity. In the corporate valuation model, the dividend discount rate, the discount rate is the weighted average cost of capital. So we've got -5 is the cash flow in the first year, 10 is the cash flow in the second year, 20 is the cash flow in the third year. After 3 years, cash flows are going to grow at 6% a constant rate. So it's just like the stock problem. So 20 times 1.06 is 2120. It's like D4, it's free cash flow 4, divided by WACC minus G, and that's 530. So this is the value of the company at time 3. And so again, using my financial calculator, I would put in negative, first of all, 0 is cash flow 0, -5 is cash flow 1, 10 is cash flow 2, and 530 plus 20, or 550, is cash flow 3. I is 10, and the value of the company is 416.942. Okay? So the mechanics are exactly the same as the non-constant growth. The only difference is we're using free cash flows here instead of dividends. So the firm has $40 million in debt and preferred and 10 million shares of common, and so I take my total firm value of $416.94, I subtract the money that is basically owed to the debt and the preferred stockholders, and that leaves me $376.94, which is the intrinsic value of the equity. So if there are 10 million shares outstanding, the stock price is $37.69. Okay, this is a really, really great model because you can actually use it managing the firm and see what is the impact of changes you make on free cash flows and trace it through to the stock price. So this model is used for what we call value-based management, managing the company to the stock price and connecting your free cash flows to the stock price. I'm not going to even talk about the EVA method because we can't get into it enough in this chapter. Very briefly, analysts also use multiples to value companies, and the idea here is that the market sets multiples, and so if we can discover a similar firm, we can use what the market is telling us is the right multiple between price and earnings, price and cash flows, price and sales to value a company. So if I see that firms similar to me are selling for 20 times earnings, and I know my earnings per share, I can use that 20 times PE ratio to calculate a stock price. What I would say about that is these are maybe rationality checks. And so if you use the corporate valuation model and you come up with a price of $37.69, check how reasonable that is by using a PE, a market determined PE, times your earnings and see if they come up close. If they don't, perhaps your free cash flow estimates are not right. Okay, so this is a good check on a more sophisticated model. Very briefly, preferred stock is not equity. Preferred stock is a hybrid security. It's a cross between common stock and debt. Preferred stockholders receive a fixed dividend. It doesn't grow like common stock. It has a par value, but unlike a bond, you're not promised to get your money back at any point in the future. Preferred stock dividends have to be paid before common stock dividends excuse me, can be paid. But if a company omits their preferred stock dividends, they're not pushed into bankruptcy like they are if they omit a payment on a bond. So it's somewhere between debt and equity, and the valuation of preferred is the same formula that we saw before. Preferred stock dividends don't grow, so this is the constant growth formula with G equal to 0. So the value or the price of a share of preferred is equal to its dividend divided by the required rate on the preferred. And so in this case, if it was 10%, 5 divided by 10 is 50. And the expected rate of return, just flipping this around and solving for return, the expected rate of return on the preferred is 5 divided by 50. Okay, so that's stock and preferred stock valuation in a nutshell.